The stock market is rigged, there I said it, and every conspiracy theorist, every Reddit thread and every guy who lost money on GameStop and needed someone to blame, they're all nodding right now. Because here's the thing, they're right for the wrong reasons, and being right for the wrong reasons is actually more dangerous than being wrong, because it sends you running exactly in the wrong direction. The market is not rigged by shadowy cabals meeting in the underground rooms. It's not rigged by the Rothschilds or the Federal Reserve or George Soros or whoever the villain of the week is on financial Twitter. It's rigged by math, by structure, by information asymmetry, by incentives so deeply baked into the system that most people never even see them. And once you understand how it's actually rigged, you can stop being the person it's rigged against. Welcome to the Top Finance. Today we go deep into the actual mechanics of market manipulation, and we start with the uncomfortable truth that the biggest threat to your portfolio isn't the Wall Street, it's you. Let's start with something called high frequency trading, HFT. Right now as you watch this video, there are computers executing stock trades in microseconds, not milliseconds, microseconds, 1/1,000,000th of a second. These machines sit physically inside stock exchange buildings, paying premium rent for the privileges so that their trade travels slightly fewer feet of fiber optic cable than everyone else's. They are buying and selling stock faster than your brain can process the concept of buying and selling stocks. What does it mean for you? Every time you place a market order, not a limit order, a market order, these algorithms see your order coming and adjust prices in a fraction of a second before it executes. You pay fractionally more than you should have. They pocket the difference millions of times of a day from millions of retail investors. Individually the amount is tiny, fractions of a cent per trade. Collectively the HFT industry extracts billions of dollars per year from retail investors through legal mechanism most people have never even heard of. This is not illegal, this is not a conspiracy, this is the structure of the market working exactly as designed, just not designed for you. Fix, always use limit orders, not market orders. You control the price you pay. The algorithms cannot front run a limit order the same way. Here's the second way the market is actually rigged against you. Information moves at a different speed depending on who you are. When a major company releases earnings, you read it on your phone maybe 30 seconds after it hits the wire. Professional traders with the Bloomberg terminals get it faster. Institutional investors with direct data feeds get it faster still. And in some document cases that have resulted in SEC investigations and fines, certain players get material information before it's technically public at all. But here's the legal version of what happens every single day and never makes headlines. Institutional investors, hedge funds, pension funds, investment banks employ armies of analysts. These analysts spend their entire career talking to company management, visiting factory floors, tracking satellite data of parking lots to count cars, monitoring shipping container movement, running proprietary models with thousands of variables. By the time a piece of information reaches a financial news app, by the time it gets packages into a headline you can understand, it has already been priced in by people who knew it was coming weeks ago. You are not trading on information, you're trading on yesterday's news dressed up as today's opportunity every single time. Fix, stop trying to trade on news. You will always be last. The only rational response to information asymmetry at this scale is to stop playing the information game entirely and invest in the whole market through index fund. Now we get to the part that should make you genuinely angry. Your financial advisor, if you have one, is probably not legally required to act in your best interest. Let that sink in for a second. There are two standard financial advisors that can operate under in the United States. The fiduciary standard, which legally requires them to act in your best interest about their own, and the suitability standard, which only requires them to recommend products that are suitable for you, not the best for you, not the cheapest for you, just suitable. And financial advisor operating under the suitability standard can legally recommend mutual fund with the 1.5 0.5% annual expense ratio when identical index funds exist with 0.03% expense ratio, because both are technically suitable for your goals. The difference in their recommendation: the mutual fund pays them a commission, the index fund pays them nothing. Over 30 years on $100,000 investment, that 1.5% expense ratio difference cost you approximately $150,000 in last compound growth. $150,000 gone legally with a smile and a handshake and framed certificate on the wall. Fix: always ask your advisor if they are the fiduciary legally required to act in your interest. If they're not, or if they hesitate when you ask, that hesitation is your answer. Here's the part where we stop blaming Wall Street and start looking somewhere more uncomfortable. The most powerful force rigging the market against you is not high frequency trading, it's not information asymmetry, it's not crooked advisor, it's your own cognitive wiring, built over hundreds of thousands of years of evolution for a world that looks nothing like a stock market. Your brain is catastrophically bad at the probabilistic thinking. It overweights recent events, so after a crash you feel certain another crash is coming, and after a bull run you feel certain it will never end. Both feelings are wrong. Both feelings cause you to buy high and sell low every time. Your brain experiences financial losses approximately twice as intensely as equivalent gains. Losing 1,000 feels roughly twice as bad as gaining 1,000 feels good. This means you will make irrational decisions to avoid losses that cost you far more in missed gains over time. Your brain craves narrative and causation in a system that is fundamentally probabilistic and chaotic. You find patterns that don't exist. You develop systems. You follow gurus. You buy the dip on a stack that has no floor. You hold the bag on a position you should have caught because selling means admitting you were wrong. Wall Street knows all of this. They have behavioral economists on payroll, the entire retail trading up industry, the gamified interface, the confetti animation when you make the trade, the dopamine loop of watching your portfolio tick up and down in real time is engineered to exploit exactly these cognitive vulnerabilities. You're not using a trading app is using you. Fix: remove trading apps from your phone. Check your portfolio quarterly, not daily. Automate your investments so your emotions never get a vote. After all of that, the rigging, algorithm, the crooked incentives, the brain that works against you, you might be wondering why anyone bothers. Here's why. Despite all of it, despite every structural disadvantage stacked against the retail investor, the market has still returned an average of 10% per year over the last century. Through wars, through depressions, through financial crisis, through pandemics, through every rigged game and corrupt actor and catastrophic crash. The rigging hurts, but it doesn't break the fundamental engine. The people who lose are the ones who try to beat the rigged game on its own terms, who try to pick stocks, time the market, trade on news, follow tips, trust advisor with undisclosed conflict of interest. The people who win are the ones who opt out of the rigged part entirely. Index funds, low expense ratios, automated contributions, long time horizons, boring, mechanical, emotionless investing. The market is rigged, and the way you beat a rigged game is to stop playing the rigged version of it. And here's the actual takeaway: use limit orders, not market orders. High frequency traders cannot front run what they cannot predict. Stop trading on news. By the time you read it, it's already priced in. Verify your advisor is a fiduciary before you trust them with a single dollar. If they won't answer the question directly, walk out. Remove trading apps from your phone, or at minimum turn off real-time price notification. Your emotions are a liability in a probabilistic system, and invest in low-cost index funds on a regular automated schedule regardless of what market is doing, not because it feels good, but because the math works even in a rigged game. The stock market is rigged. The winning move is to invest anyway, just not the way they want you. This is the tough finance, the wasteland where we play rigged games and still come out ahead. Subscribe, because the next video is going to make your trading app even more uncomfortable than this one did. And if you still have real-time price guys notification turned on. Turn them off right now. I'll wait.